In today's video, I'm going to talk about and rate a list of the different property investment strategies. Fingers crossed it will give you food for thought about the different ways to get involved into property. Now I'm going to hold my hands up and say I don't have direct experience in all of these strategies here, but I do understand them on a surface level. And of course, all of this is simply my opinion. So if you agree, disagree, or think there's anything I've missed, please let me know in the comments below. Hello people, I'm Jim. Welcome to the channel. I'm a property investor who is documenting my journey to financial freedom from my day job. I'll be breaking down everything to do with property investing, investing in general, and getting a better grip on your personal finances. So if you're like me and want to grow your wealth, then please do not forget to subscribe to the channel and turn the notification bell on so you know when I post new videos. So I've been scanning the internet and racking my brain about all the different ways which you can invest into property, and hopefully I've not missed any off. The list I've compiled is the following: serviced accommodation, HMOs, commercial property, buying your own house, buy, refurb, refinance, rent, lease options, flips, rent to rent, joint venture, deal packaging / sourcing, invest into real estate investment trusts, new builds, and finally buy to lets. I should be ranking these from S, which stands for super, followed by A through to F, like the standard grades you receive in school, but weirdly missing out E because the alphabet's only 25 letters long, so it's sound. So let's jump right into the strategy which I have the most direct experience with, and that's serviced accommodation. If you've not spent much time around the property world, you might know serviced accommodation by another name, which is running an Airbnb. Everyone knows what an Airbnb looks and feels like now. Since their launch in 2008, they've captured the zeitgeist of the space tremendously. So from an investment point of view, how does this work? Well, it involves you taking a property and doing it up to a nice standard, normally for leisure guests. So think about going to the Lake Districts for a week and staying in a nice cottage. Or you could be working away in another city for a week and you could be staying in a city centre apartment. You get the full run of the property, which will involve kitchens, bathrooms and communal areas, along with unique things in the unit, such as hot tubs. Now, I had an Airbnb business and we had 2 units, so I'd like to think I have a decent understanding of what it takes to run the business. When it comes to ranking the strategy on the list, I'm going to give it a D. I believe running serviced accommodation is not a specific property investment strategy. It is a full-on business, which involves really high levels of customer service. And at the end of the day, you're giving your guests a service to stay at your accommodation. It's certainly not passive, and at the beginning, you will always have to be at the end of the phone. But with that said, there is certainly a property element to it. You need to control the property and bring it up to a standard for it to be appealing to the guests to stay there. Personally, I think if you can control the property and kit it out to a good standard, I would give it to a management agent who will look after everything to do with the guests for you, for around 15 to 20% of the revenue. But the bottom line of SA is you can make some seriously good money, but you need to be prepared for lots of hard work for that. So in my opinion, D is a good solid place to put it. If you're interested in learning more about Airbnb, I will link my ultimate guide to starting out at the end of this video. From one high cash flowing strategy to another, we have HMOs. HMO stands for House of Multiple Occupancy, which normally has 3 or more people from more than one household living in the same property, with shared access to the kitchen and the bathroom. In some cases, rooms have their own en-suites, and this can be a really good way to command higher rent. HMOs can range in size from having 3 people all the way up to large ones with 7. Like SA, you can make some really good money from HMOs as you're renting each bedroom out. There's been lots of legislation in place over the last couple of years when it comes to running HMOs, so understanding this is critical to be successful in my opinion. Now, I've been lucky to spend time with lots of investors who have decent HMO portfolios, so based on my experience spending time around these people, I'm going to give HMOs a really good A. Now, it's just one tier below the top, and there's one major reason for this: managing the tenants. Now, this is of course one level below running an Airbnb business, as you're not constantly doing different changeovers with different guests. But the potential is there for you to have to act like a social worker when one tenant has nicked another tenant's cheese, or if one of them rocks up with a new pet iguana stinking the whole house out. A lot of this will depend on the area and the type of tenant profile you are targeting. But overall, I love HMOs and will consider getting into them at some point because, like previously mentioned, the cash flow can be really good. However, personally, I would want some good tenant managing experience before I jump into it. But overall, it's a really good, solid property investing strategy. Next up, we have commercial property. Now, I'll hold my hands up and say I'm no expert in this strategy, but as I understand it, the principle of commercial property investing is actually relatively easy, even though it seems really complicated. You would purchase a commercial building, which may be a shop or a warehouse. Then you will get a business to sign a lease to rent the property out for a certain period of time. Normally, they tend to be pretty long, as most businesses, understandably, want the security of knowing that they are in the same location. So you may get a business signing a lease for 20 years. Normally in this lease, it will outline the responsibilities of the tenant and the landlord when it comes to maintenance. So with that said, where am I putting it on my ranking list? Well, for me, it's a solid B. Like many property investing strategies, there are times when it works better than others. For example, I doubt commercial property investing was pretty hot in 2008. And maybe as we've seen things move more online, their opportunities have been in owning warehouses for big online retailers like Amazon. But overall, I really like it, and it'll be interesting to see how commercial property does over the next 18 months as things start to get back to normal. Next we have where I actually think everyone should start when it comes to property investing, and that is buying your own home. Sometimes I think people have the ability to forget that if you make a sound purchase when it comes to the house you live in, it can pay dividends in the long term. Personally, I think it's worth doing lots of research into capital growth within the area which you're going to be investing in. This is even more important if you're buying your forever home. If you're staying in a place for 30 years and by the end of it you're mortgage free and have seen some lovely growth in the value of your property, when it comes to you downsizing in the future, it can act like another pension pot. So make sure you do your research into where you are purchasing. Personally, I bought my house in an area with decent capital growth and a strong rental demand. My vision is to keep my first house and rent it out when me and my girlfriend move on. So where does this land on the ranking list? For me, it's got to go in an A. This is because this is the side of property investing which most people get involved into. And like I said, if you do it correctly, you could end up boxing yourself off big time in the future. Even if you don't want a massive portfolio, if you can make a good investment in the house you live in, you'll get a lovely house and hopefully you'll get an asset which will improve over the long term. The next approach is what seasoned property investors use to build up massive portfolios with the same pot of money. It is BRRR, which of course stands for buy, refurb, refinance and rent. And again, like most property strategies, it's simple to understand but difficult to execute. You will buy a property which is in a bit of worse for wear and needs money spending on it. Always make sure you buy at the right price because you will make your money when you purchase. Within property circles, this is often known as BMV, which stands for below market value. So once you've done this, you'll get the paintbrushes out and spend time doing a refurb on the property. Once this is finished, you will have a lovely fresh property, which will be worth more now you've added value to it. Normally after 6 months you can do a thing called a refinance, which is where you get a mortgage on the new higher value of the property, and if done correctly you can pull most of your money out, or in worst case leave a few £1,000s in the deal, but you get most of your big pot of money back out to go again. Then when all of this is done, you get to rent it out to a tenant to get them to pay down your mortgage whilst making money off the cash flow. For me, this approach has got to go at the top tier, landing firmly in the superb camp. This is how lots of big investors build up their portfolios, and it's something I would love to be able to do. I love it for a few reasons. Firstly, obviously you get to use the same pot of money to purchase properties every couple of months. Like most property deals, you get really good leverage from the banks in the form of a mortgage. Then finally, you get a lovely asset to hold for the long term. With that said, it's probably not the ideal time to try and use this approach with house prices going mental, but hopefully when things calm down a bit, it'll be more of a goer. Now, we have a pretty creative strategy, which is lease options. This involves you coming to an agreement to purchase a property in the future for a pre-arranged fee, which is the option part of the deal. The lease part of the deal is when you will pay a landlord a monthly fee for the property. In order to best understand this, I will give you an example. Let's say I find the property worth £90,000 and I agree with the landlord an option to purchase the property for £100,000 at any point within the next 5 years. Another important thing to mention with lease options is that you have the right to purchase the property but not the obligation. Normally you will have to pay an upfront fee for the option, which could be as little as £1, which means you can purchase the right to buy a property for £1, which is actually pretty cool. Finally, you will agree to pay the mortgage of the property, which is the lease. So let's say this could be £300. Once you have the lease option, you technically have control of the property. So you can start renting it out for say £600 a month, for example, meaning you might make a net of £200 per month after your costs, which is not bad for £1 up front. Then over the next 5 years, you can keep a keen eye on the property prices to see if they've gone up. And then you could exercise your right to purchase the property, and maybe sell it straight away or keep it for the long term. This is a good approach when you find landlords who want to get rid of a headache really quickly, as you can cover the mortgage for them every single month. So with that said, I think lease options go in a solid B for me. It's a really good way to get involved, but it does involve some knowledge of the legals, which if you're new you might not have the confidence in, which is where it pays to have a good network around you to bounce ideas off. It might also take some time to get agents and landlords to buy into this approach, so it might take some trial and error, but there is no doubt if you can pull one of these off, it could be a phenomenal deal. Can you guess what I'm going to talk about next? It is of course flips. This is one of the classic property strategies. It involves buying a house which needs a shed load of stuff done to it. Make sure you buy at a decent price. Like we said earlier, you make your money when you purchase. Buy the house, then do a decent scope of work on it and add a load of value to the property. Once you've done this, you can then sell the property on the open market, with the view that you will make more money than you spent purchasing and refurbing the property. A really simple approach to understand. With that said, for me, flips have to be top tier. I think it's a really good way to get involved into property. One of the major issues which most people experience in property is they do not have large amounts of money in order to invest. So starting out doing flips is a great way to get these big chunks of money. Hence the reason for me it's top tier. Another reason, people have been flipping properties for a long time, so we've got a good solid track record that it works really well. Next up we have rent to rent. Rent to rent, similar to lease options, is often pitched as the low or no money down property investing strategy, which is partially true. It involves you renting a property off a landlord and repurposing it to maybe operate it as a HMO or an SA unit. You will pay the landlord rent each month with the view that when you repurpose it, you will charge more money by renting it out by the room or by the night. So it is similar to lease options, but you do not have the option to purchase the deal. Now, I had a rent to rent for my second Airbnb unit, and I actually made a video discussing why you should never do rent to rent for Airbnb. So please check that video out in the link in the description. But overall, I will put rent to rent in F, bottom of the pile, in the bin. Now there are a few reasons for this. Firstly, I would say you can make some good cash flow if you do it correctly, but you have to earn it. Essentially, you are a managing agent, which is hard work. For me, this is not where I want to be. It works really well for some people, especially if you're starting out and looking to replace your income from work as soon as possible. But the biggest drawback for me is you never own an asset. And unless you link your rent-to-rent deal with a lease option, you will never own the property ever. Which for me is the whole point of property, owning the asset for the long term. Some people just want to control the property in order to make good cash flow each month, which is cool, but that's not my vibe. So rent-to-rent is bottom of the pile. Next on the list is joint ventures, simply known as JV. It involves partnering with someone else who has money or time to invest into finding properties. You might be a newbie to property who has no money but loads of time and energy to invest into finding property deals. Or you could be at the other end of the scale. You might be a bit older with a decent amount in the bank, which you want to invest but do not have the time or want to spend your time on other things. When these two people join together, this is known as a joint venture. Both parties bring something to the table: money, time/energy. So you could go on the hunt for property deals and go 50-50 on them. This can be really good starting out point for newbies, as you can normally find someone in your wider network who'll be willing to stump up some money to invest with you. For me, JVs land in a solid B. Like I said, I think it can be a brilliant starting point for beginners, but I think it's important in any relationship, but even more so in business, to make sure you outline expectations and how the deal is structured, so everyone's on the same page and there's no unexpected surprises. Next on the list, we have deal packaging and property sourcing. The way this works is you can go out and find deals for investors, provide the service of finding the property, managing the purchase, and even managing the refurb process for them. Obviously, for this service, you will charge the investor a fee. It can be a flat fee or a percentage of the project. Different people do this in different ways. Sometimes people have a small group of investors who they work with on a bespoke service, or sometimes people have a database of investors who they email deals to when they come in. Both have pros and cons, but they are just different ways of doing it. Overall, I think deal packaging and sourcing for me lands in the middle of the pile with a C. I think it can be a good way to make cash flow from property, but I think you need some decent experience to get buy-in from investors. And like anything, it will take time to build a base of people who you can work with. So I think for me, the middle of the pile is fair. We've smashed through these and we only have 3 left, so let's jump into investing into real estate investment trusts. These are companies that own, operate or finance income generating real estate, basically pooling capital of numerous investors and then investing it into property deals, meaning you can earn dividends from property without having to buy, manage or finance properties yourself. For me, this is another C. It's a really good way to invest into property. If you do not have all of the capital to purchase a property yourself, and it'll be the most passive way ever to invest into property, as you do not have to worry about all of the moving parts. But the rewards will not be as high, that's due to the lower risk. So overall, if you're risk averse or want an easy way to invest into property, this is the one for you. Second to last, we have new builds. This will involve you purchasing land and getting all of the relevant planning permission to build on it, then building some brand new properties on it. As far as I understand it, I think the planning process can be the hardest part to manage when it comes to new builds. Sometimes people will buy land and then just sell it with planning permission, because banks tend not to lend on land without planning permission. So this can actually throw up some issues when it comes to financing the project, as you may need lots of capital up front. But if you can manage this, I've been informed that building new houses can actually be easier than a refurb on an old one. How true this is, I'm unsure, but they both have their own unique challenges. Once you've built them, you can either sell them on straight away or keep them to rent out. I think new builds are a complicated strategy, but can be really profitable, so for me they jump in at an A tier. New builds are something I would love to get involved in once I have some more experience in property. Finally, we have the big dog, buy-to-lets. This is the bread and butter of property investing. You buy a 2 up, 2 down and rent it out to a tenant, making a couple of £100 a month cash flow, whilst owning an asset which should go up over the long term. I love buy-to-lets. I think it's a really basic but the fundamental property investing strategy. And I think if you go hard on buy-to-lets while you are young, you will never regret it, as you will get a decent cash flow each month whilst owning a shed load of assets. So we need a drum roll, please. Buy-to-lets for me go in top tier. Superb for buy-to-lets for me. I know some people will disagree with me, but I think it's time tested. It's super basic and really easy to understand. Of course, it's not as fancy as some of the other strategies, but I don't ever see buy-to-lets going out of fashion. So that's why for me, it's the big dog of property investing. I hope you guys have enjoyed my rankings, and please let me know in the comments what rankings you would give each property strategy. And if you think I've missed any off, please let me know. Do not forget to subscribe to the channel and give this video a like. And if you're interested in learning about Airbnb, please check out my video now. And I'll see you in the next one, guys. Cheers.